Thank you for attending today's webinar, When Payments Fail, Sizing Up Downtime in the Digital Surge. Before we get started, I would like to go over a few items so you know how to participate in today's event. We've taken a screenshot of an example of the attendee interface. You should see something that looks like this on your own computer desktop in the upper right corner. If you have joined the presentation listening using your computer speaker system by default, and you would prefer to join over the telephone, just select telephone in the audio pane and the dial-in information will be displayed. You will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel on the right-hand side of the screen. You may submit questions at any time during the presentation. We will collect these and try to address as many as possible during the Q&A session at the end of today's presentation. I would now like to introduce Heather Clifton. She will be moderating today's webinar.
Thanks so much, Keely. As Keely said, the title of today's discussion is When Payments Fail, Sizing Up Downtime in the Digital Age. I'm Heather Clifton. I'm the CMO at I2C, and I'll be moderating the panel today. A recent Celent white paper summed up the expectations associated with payments. I quote, "Like electricity and water, we take payments for granted and only realize the importance of reliable and resilient payment systems when things go wrong. And yet, as these headlines attest to, things have been going wrong in payments with frequent outages where consumers are unable to pay or access their money." As a Lucky Strike Extra, you can download a copy of that Celent white paper entitled Ensuring Payment Systems Resilience by clicking on the chat and then looking for handouts. You'll be able to download it there. There'll be another reminder at the end of the call about that as well. Really excited about the group of panelists that we've pulled together today. I think they're going to give us a broad and very unique perspective that will add to today's discussion. So to kick us off, I'm going to ask each of the panelists to introduce themselves, and let's start with the order on the slide with Jim McCarthy.
Thanks, Heather. Thanks for having me today. I'm Jim McCarthy. I'm president of I2C. Been here since March of 2020. Interesting time to join a company. I'm sure we'll talk about some of the aspects of living through COVID. But prior to that, I was 18 years at Visa in various positions, from global product to innovation and strategic partnerships. Saw a lot of change over that time. And prior to that, I was 13 years at IBM supporting various companies on the way to becoming Bank of America.
Great. Andy, you want to go next? Andy? Oh, you're on mute, Andy.
Oh, I beg your pardon. I think I had a momentary freeze. Yes. Good morning or good afternoon, everyone. So I am the Executive Director of Research at the Uptime Institute. So Uptime, we really began our life helping organizations design reliable data centers. Over the last, especially 10 years, we've branched out and we help organizations not only design, build and run data centers, but also their critical infrastructure generally. And we advise really how to run resilient, sustainable, critical infrastructure, which obviously is supporting a lot of critical applications. So we look at all of those areas, and my particular job is really to research what goes on across the world in terms of things like new technologies, but also things like outages, downtime, etc. How the industries, many industries, are dealing with that.
Terrific. So great to have you join us. Richard?
Hi, everyone. My name is Richard. I represent Downdetector, which is part of Ookla. And Downdetector, as many of you know, is the go-to site globally for consumer outage reporting on all services within specific regions. We look after today about 10,000 plus services, and we monitor about 45 different countries. Our job, or Downtexter's job, is purely to represent the consumer's perspective on outages and downtime in any given market and report on that. We also provide enterprise clients quite a bit of insight into that data and that crowdsourced data. Glad to be here. Thank you so much.
Right. So I think you're already starting to see the breadth and the different perspectives that will come into play today. So Jim, why don't we kick it off with you, as someone who spent the larger part of their professional career in payments. Set the stage for us. Think about when you started in payments, some 20 years ago, to where we are now. What's going on? What's different about this moment in time as it relates to payments, reliability, and downtime?
Thanks, Heather. So you're going to set me up to be that guy and date myself and talk about when I used to carry ice up flights of stairs and that kind of thing. So thanks for aging me. It's actually probably closer to 30 years in the space if you count my days at IBM working with Bank of America. And I think it's important to kind of start there because it's the early 90s, let's say, working with the credit card group at the bank. I mean, people forget because memories are like this. We live in a very different age, but back in the early 90s, a lot of the systems that the bank used to do everything from like fraud to marketing were offline. And transactions, not all of them are online in real time. Authorizations could take a day depending on what market you're in. Europe, as an example, did not go online for authorization. So the concept of real time and 24/7 were really only invented in some ways over the last 20 to 30 years. Again, to put it in real world terms, and again date myself. I'm a child of the days when stores weren't open all the time. I remember when grocery stores started to go to 24 hours, and I thought, wow, that's kind of incredible. So you kind of flash forward, and we think in the last 20 years or so, going back to the 2000s and the advent of the commercial internet. But for those of us who were around during that period, even banking, there were a lot of times where I'd log in on Sunday to my online bank if I had it, or most likely it was web versus mobile. And there's a lot of scheduled maintenance. So I grew up in a world where I was surprised and delighted to find things that were up and open. Whereas today, especially in a post-COVID world, the expectation is we're living in a 24/7 environment. Don't tell me about scheduled maintenance. Now when I kind of log in to do whether check my investments or check my bank account or pay a bill or shop from a merchant, and I find that they're down, whether that's again for scheduled or unscheduled reasons, I move on, right? And certainly if it's something I'm relying on, I'm not happy about it, because the expectation for the consumers and businesses around the world is it's 24/7, and you better be orchestrating your services accordingly. And I think, as I mentioned earlier, on the back of COVID in particular, it's only raised the stakes for everybody involved, and not only payments, but commerce, and I quite frankly say just about every service that we expect as consumers and businesses.
So has the expectation changed, in terms of mission criticality of payments, or is it just kind of the circumstances around it?
No, I think the mistake we make is to kind of segment out payments as some kind of unique activity. I mean, the way I put it, and again, we're all living this regardless of where you're in the world, with like the global supply chain as an example. It's hard to believe that chip shortages ripple through things like cars and cargo ships that are stacked up at ports. But payments is a key part of commerce, and commerce drives the world. I mean, we all, whether you're a consumer or business, rely on third parties to deliver services every day. Increasingly, those services are digital, and with digital and certainly with the advent of the smartphone in 2007, expectations have completely changed. We are completely interconnected, and nothing happens, whether it be in B2B or B2C, without payment. It's part and parcel of the commerce experience. And so to put it outside of that and try to measure availability or reliability independently, I think is a fool's errand.
Got it. Andy, what's your sense of how prevalent downtime is? How often is it happening? How many customers are impacted?
Well, so that should be an easy question. it's not, because in a way, the in support of what Jim was just saying, the level of IT and the expectations of it have gone up so dramatically across the world in the last decade or so, that it becomes very apparent when there is an outage. It's very, very noticeable, but also the amount of IT out there has gone up dramatically. So in fact, the real trend is that outages are going down per transaction or per amount of IT delivered. But at the same time, what is happening is the actual number of outages are going up, just because there is so much more IT out there. So it is slightly paradoxical. It's a bit more complicated than it seems. And another complication is that not all outages are binary. Sometimes it's just parts of an application are missing, or some of the data is missing, or things slow down so it becomes unusable. But that doesn't necessarily get recorded by the operator or supplier as an outage. So it's pretty complicated. Having said all that, the chart that you see there does show that we do some research on this. We do this every year. We get about 1,000 people normally answer across the world, and we get very consistent results. So about 3/4 of the managers that we talk to say we did have some kind of outage in the past 3 years. And then about 1/5 to 1/4 of these they class as serious or severe. And by that I mean they had financial losses, reputational losses, customer impact, and so on. So it's difficult to actually point to all the trends, but what we can say is this: outages do occur regularly. There is no section of the world, of the business world, that's immune to it. Most managers in big organizations can expect to have to deal with it many times in their career, and yes, it is definitely having an impact. And you were asking about who gets affected by it. Well, the answer is almost everybody, because everybody's affected by IT now. So whether it's a payment system or an airline or whatever, it happens, and it does affect people sometimes quite seriously.
How about financial services specifically? What are you seeing in that space when it comes to people, being able to access their money and pay?
Right. So again, it's a really interesting sector, because you see the chart there. So you have these sectors that are like professional IT companies, cloud companies, internet giants, telcos, digital services. They all actually have, when it comes to being reported in the media, social media, or through things like Down Detector, I'm sure Richard can talk about it, they come up a lot. And that's because they're so prevalent, so widely used, and when something happens, it's noticed. And financial services, paradoxically, spends more on resiliency and redundancy and ensuring things run, and yet because they are so in the front line and their services are so critical, they get noticed. So financial services, that it comes up a lot. We find that of all the sectors, it's the professional IT industry and the financial services industry that invariably come out the top two.
Okay. Richard, how about you? What are you seeing from Down Detector's sort of direct-to-consumer vantage point?
Right. So, one thing Jim and Andy said that, back in the day, it was more Jim that said that back in the day, it was a different type of setup that used to be in place. It was, quote unquote, legacy setup, where all these financial institutions or banks had full control to a degree to the applications that they use to serve their consumers. In today's world, there's a lot of dependencies on external service providers. So if you're a financial or a payment company, you're looking at cloud service providers, you're looking at e-commerce websites, you're looking at the ISP itself to be operational and delivering your service. It's no longer only your data centers, your infrastructure that guarantees the delivery of your service to the client. And so they became a bit to a degree, not able to control all of the environment that their consumers are in because of all these dependencies. And what we do, what Downtector does, or what provided the consumers and the financial institution, is the ability to have that holistic view. Look at CDN, look at cloud service provider, look at all the components that drives your service from point A to point B, which is the consumer, and provide you insight on every single step of the way. And consumers find that very valuable because they found a way to have their voice heard and heard in real time. That's why they go to the internet to report on their issue, report on a provider, and through that search that they do, they realize that it could be a third-party situation affecting their service. Case in point, a CDN outage that takes place, and I think there was one in July of this year, that affects everyone. Everyone who has any relation with that CDN service provider, although it's not their issue, it's an external issue to them, but it still affects their business, their revenue, and their consumer perception of the issue.
Yeah. Tell some stories, like, you're seeing consumers comment directly, in terms of what they're experiencing. What is the actual human impact of outages and downtime on the people you're hearing from?
Right. So, I mean, there's a lot of examples. I can cite a few recent ones. With the recent large social media outage that took place, everyone was affected. Financial institution, ISPs, e-commerce, you name it. And if you think about social media, it's no longer just a social media platform. It became also an e-commerce platform to a degree. A lot of the e-commerce world do post through these sites and do sell their merchandise through that, and that includes also payment integration with different payment companies out there. When it failed at that scale, we reported about 14 million consumer reports at the beginning of that outage, and it went on for multiple hours and affected. We did an article that we released and affected the top 25 countries were affected. We're affecting a huge number of folks, a huge number of organizations across these countries. Consumers take to the internet immediately when there's an issue. They're on their phones, they're on their web, on their computers. They face an issue with any platform they're on, financial institutions, banks, mobile apps, and they go to the internet, they tweet about it, they search about that situation, and it became a near real-time behavior and reaction from the consumers to the internet. And through that data, you're able to tell a story of what's going on out there. Is it really that bank? Is it really that financial institution? Or is it more what they've integrated with that's causing everyone a headache?
So Heather, if I could chip in,
yeah.
And I don't know if I'm supposed to mention names, but I will, because it was very widely publicized. So when Visa had their issue in June 2018, so it was a while back, in Europe, it was all over the TV news. It was all over, the media the next day. There was about 5.2 million payment transactions failed. So that's 5.2 million people trying to pay for their meal, trying to get their ticket home. It was in a busy evening in the middle of summer. And as a result,
what Andy's not saying is it was Friday night. People were headed to the pubs.
You're spot on, right? I mean, imagine
talk about human impact.
You're buying your drinks and then you can't pay for it. I mean, yeah. That can take a while to sort out. So, and then in the following week, the Treasury Select Committee in the UK Parliament said, this regulation to ensure that this doesn't happen cannot come soon enough, were the exact words of the chairman of the committee. So, I mean, that's an example of just how critical payments have become, which, we have a term, we call it creeping criticality, where things become more and more and more critical as the years go by. But that doesn't mean the systems are getting upgraded at the same rate as they become more important. So, it clearly has a very dramatic impact on people's lives, and there's no real non-digital alternative. People don't carry checkbooks anymore. They may have had the cash, but not necessarily enough.
But just to add on to that, Andy, I think it's important to note that was an interesting time for Visa in that Visa had acquired Visa Europe probably 2 years earlier. And one of the main drivers for Visa Europe selling the franchise to Visa Incorporated was the investment, the increasing investment needs for the core infrastructure that was aging, the IT infrastructure. And so that outage, as unfortunate as it was, occurred during the transition to the Visa Inc. infrastructure. So every point Andy made was spot on with respect to the consumer impact, but also some of the drivers just for consolidation, just being the core infrastructure and the costs and the stakes involved with it.
Yeah.
Right.
So,
And
so
when you were
speaking-
asking, when you were asking about financial services and the prevalence, we do find that because many of these larger established organizations, they have this legacy infrastructure. And at the same time, they're trying to add on mobile banking and digital finance and all these other services. And they're trying to upgrade to a cloud infrastructure and a DevOps environment and all these other things. And that is a real major time for risk. And that's caused a lot of problems at a lot of organizations.
Cool. So you guys are already kind of segueing into sort of the next topic, which I love. So several of you have sort of mentioned the value chain, a lot of different players, that are now part of payments and banking. Richard, do you want to talk to what you sort of see in a unique vantage point at Down Detector, where you can see all across the value chain when an outage happens? It may, from a consumer standpoint, it may be, my Visa card isn't working, but you get to see the whole perspective and can kind of see where the issues are. Talk to me a little bit about this interdependency of these failures.
Sure. And if you look at it from a consumer perspective, right now, 2021, consumers have multiple ways of completing a transaction. So if they're on, an e-commerce site or trying to book a flight using an aviation site or any other site that requires a payment, they don't have a single option anymore. They have multiple options. And when things fail for one payment company, the consumer is going to default to another one just to complete that transaction. Meaning, if you consider booking a flight, you've got a good rate on that flight, you want to make sure you get it before the rates change. You try one payment method and that fails, you switch to the other one, you secure that. That translates to the payment company that did not complete that transaction. That's equivalent to loss of revenue there. Now, from our perspective, when we're sitting from a Down Detector standpoint, we see not only the elevated reporting on a specific payment company, but we see everything around it. We see the ISP reporting, and we determine whether or not this is a ISP outage, a carrier outage in that region causing that payment company an issue. We see the sites that payment company integrate with, be it an e-commerce and aviation. You might have an airline that's having its site down, and consumers are trying to do a payment at that transaction level, fail to do it, but it's not the payments company. So our vantage point is really a holistic vantage point. We're able to see often what's going on in a given market and understand that this is not that specific service provider situation or issue, rather what's around that. A quick example, recently a bank have had elevated reporting and what is as a consequence, elevated customer care calling, tweets about the brand and the mobile app not working or the website not working, and that lasted for a few hours in a day. Whereas from our standpoint, we realized that all that data is coming in from a single carrier in that specific region. And through different data points that we can see, we realize directly that there is an outage related to an ISP, not the actual bank, but the consumers are not expected to know the difference. If you are on a mobile app doing a transaction with a bank and it doesn't work, the first instinct is to blame the bank. Our job here with Down Detector is to figure out a holistic view around that situation and understand what's going on.
Yeah. So Jim,
and I want to add to that real quick, Heather, was to the point Richard was making, especially in payments these days, that switching cost has all but disappeared. I mean, it used to be, what was in your physical wallet, and the choices were limited. I mean, with virtual wallets, I mean, certainly in the case of Apple Pay and Google Pay, you can load everything into that wallet at your fingertips. They're not in the sock drawer anymore. And so when, as Richard pointed out, that transaction fails, regardless of where in the value chain or the payment chain it happened, you can easily switch to another payment method. And now in this kind of top of wallet e-commerce game, once it's set, oftentimes people forget it. So that bank has now lost the customer, and they kind of have to hope that there's something bad happens to their competitor, so the customer has a reason to switch again. I mean, it's just the switching costs of this all but disappeared.
Yeah. The fragility, as you guys are talking, I'm thinking of this, like a paper chain it used to do at holidays, and just the power of the weakest link to knock things down. So Jim, you've done a lot of work with partnerships, collaboration, looking at the various players in a chain. What advice do you give to someone when they're trying to choose 4 or 5 different partners to be part of their value chain? What kind of questions should they be asking? What should they be thinking about?
Yeah, it's really interesting. Again, the time we're living in. Having spent again a large portion of my working life at Visa, reliability was always a big part of the discussion. I mean, it was as the panelists have noted, banking is a different animal when it comes to both regulators' eyes and consumers and businesses' eyes. Always has been. And so at Visa, it was always a big discussion. I mean, when we moved data centers, as an example, from the West Coast to Ashburn, Virginia, part of that discussion was around safety of the data center, like just looking at the earthquake zones. And when they picked Ashburn, there was a whole lot of work that went into finding a site that was kind of out of hurricanes and out of earthquakes, et cetera, because reliability and availability were critical to a global network. So what's funny to me is you wake up in 2021, and the discussion very rarely, certainly in the markets we serve at I2C, which are global markets in the payment space, very rarely do customers come to us right out of the gate and say, well, how reliable are you? What's your data center architecture look like? How who's running the platform? Some of the more sophisticated customers, certainly in the financial institution space, get there quickly. But in the fintech space, the discussion oftentimes starts around the how modern are you? And you actually see some funny stuff going on, having just come from Money 2020, where there were new entrants into the payment space that were arguing, like, we're more modern than this other guy because we're brand new and they're 10 years old. And I find it interesting that people are willing to put potentially their online bank or their payment ecosystem on a platform that's hosted by a company that has less than 50 employees, and reliability cannot be in the discussion. So what we often do is kind of point people to discussions that I would have at Visa, which is you need to peel back the onion and start to look at everything from the base foundation of where these companies are hosting their infrastructure to what software are they running on, what partners are they connected to, because unless you truly understand that, you have no idea what type of service delivery that you'll and expectations, quite frankly, you can set and deliver on. And so it's really important for folks to understand what 5 nines means versus 3 nines or less, and all the various components that go along with that.
Jim, we're showing up a slide here because it's what's the difference between 4 nines and 5 nines? I mean, like, how could it possibly be a difference? Give us some context on that.
Well, the context is this: you get into a lot of debates, and they seem silly at the time, but unless you look at a slide like this and understand what it means, we face a lot of new entrants who, in order to kind of save costs and get to market with their most modern of modern platforms, so to speak, they host their technology stack in public clouds, right? I think it was Andy making the point earlier, and it may have been Richard as well, about how legacy banks controlled as much of this as they could. Well, in a day and age of cloud and public clouds in particular, a lot of companies have rushed to, hey, I'm going to go into the cloud because it's got to be better. Well, if you look at the SLAs just out of the gate where I'm going to host my infrastructure, I think AWS contracts, and they say we're going to provide commercially reasonable, that's a pretty broad truck you could drive through, efforts to deliver 4 nines, right? So that says out of the gate, for a company that's going to host its service on AWS, the kind of the starting point is an hour of downtime a month, right? If you look at Azure for Microsoft, they offer 3 nines, and Google is somewhere between 2 and 3 nines. So depending on where you're starting from, you're either out an hour a month or potentially more than a day a month, depending on who your public cloud provider is. And that's the starting point, right? Then you've got to get into what most people think of as an alphabet soup, but it really is important to understand things like ISO certifications and so PCI DSS, which is that, and ISO 27001 are around info security, right? Where's the data? Who's got the data? Who can get access to the data? And remember, we're talking about sensitive financial information. You can get into things like SOC 1 and SOC 2, more importantly, which is, are you auditing the IT availability? And then even further things like, and I think both gentlemen stated this, things are going to go wrong. I mean, let's face it, in a highly interconnected IT environment, bad things do happen, regardless of how well you're architected. And so there's things like ISO 23001, which is around business resiliency. So what do you do when bad things happen? And I think you have to expect bad things are going to happen. And so unless you're architecting for these things, asking your vendors hard questions about the starting point, let alone a bunch of other things you need to build on top of, you better expect you're going to be delivering unfortunately not a great experience to your end users.
Heather, if I could chip in, we at Uptime, we're very cautious of these 5 nines numbers. The whole methodology really was developed for something called failure mode effect analysis, where people were looking at individual components in an engineering environment and working out how often they fail. When you start building these into a system, and then that system has software running on it, and its stresses are changing at all different points during the day, and then you're linking it to a network or putting it into a cloud environment and so on, I think the science of it really starts to somewhat fade away unless you're genuinely testing it. And I think very few people actually really do the measurements. The fact is, the service level agreements, they're actually really, they're minor compensation documents to try and cover people for how much they may have to pay if something happens. And really, they're marketing documents. It's interesting that quite often, if one company improves its 5 nines figure, another one follows suit in a few weeks, even a few days, but they haven't gone back and recalculated or changed their infrastructure. They've just decided, well, can we pay a bit more? So, I'm not really sure. I totally agree with what Jim's saying, but you got to look at everything, and treat the 5 nines figures with skepticism, treat the SLAs with skepticism. I think the auditing examples that Jim's mentioned, most of those are good, but not all of them. So take the whole package and have a good look at whoever you're using, because when something goes wrong, very likely you'll take the blame, and they'll get off on a technicality.
Okay.
Yeah, and to Andy's point, though, Heather, I think it's important. That's why I try to make the point as best I could, which is this is kind of the beginning. When you look at the software stack, especially in an interconnected environment, where again a lot of these startups are renting software from others and slapping it together, you're not instrumenting those applications and monitoring. And as Andy referred to, software is actually oftentimes the culprit more than the hardware. And unless you're building hooks into it to instrument and look at kind of things that are kind of going bump in the night, things haven't broken, but you're seeing weird patterns or I think someone mentioned earlier, like where stuff starts to slow versus collapse. If you're not monitoring that, you're missing the warning signs that could lead to things that are a lot worse. And so it's very complicated. But my point around the SLAs was that's just the starting point for a lot of these companies, let alone all the other complexity that sits on top of it.
Perfect.
Right. And of course, not every lost minute is equivalent. Losing a minute you know, in the stock exchange on a Monday morning is not the same as losing it at midnight on a Saturday or a Sunday.
Yeah, the only thing I'll say to that though, Andy, though, is, and you know, I think this is the point that's also lost on all of us, because we're creatures of, you know, where we live, literally where we sit. Andy, you're in the UK, I'm in Texas, you know, and when you're in a global environment, and we've seen this, you know, is downtime when you're running in a 24/7 interconnected environment. If we're taking systems down on US time in the night, you're impacting somebody's daytime in Australia, Singapore, or the Middle East or Europe. So again, it just adds increased complexity to the whole thing, because you've got to figure out how to even do maintenance in a way that is not disruptive to one half of your client base.
I'd like to turn now to the costs. You know, and some of them are going to be, you know, dollar costs, some of them reputational costs. Andy, why don't we start with you, because I know you guys have done a lot of work to sort of you know, calculate what that cost would be, and whether it's, you know, increasing, decreasing. What are you seeing?
Well, so, you know, we get asked this, you know, with metronomic regularity. You know, what is the average cost of an outage or whatever? And you know, I think you have to caution that there is no such thing as an average cost, because some people have, you know, a really dramatic outage that is incredibly expensive. You know, we've recorded some that are in the hundreds of millions of dollars. And then obviously there's a long tail of very small outages that barely get noticed. But again, we do this survey regularly. We ask people to say, could you estimate the cost of the most recent serious downtime incident? These are for those who have recorded a serious or significant downtime incident. And yeah, we find every year the costs go up. And if you look at probably the middle bar there, the kind of light blue dollars, you know, that the ones that cost over 100,000, you know, 28% had experienced that. In 2019, it got up to 47% by 2021. So, you know, the cost of outages is going up all the time, and it's a very strong trend that we would expect to continue.
Richard, do you want to talk to some of the more qualitative sort of impacts that you see from consumers' responses to outages?
Right. So, and on the cost point there, to Andy's point, there are two costs. There's the costs that are associated with your service failing, but there's also a cost associated with external services failing you, so to speak. And you know, a quick example would be if you run a customer care and call center that service your consumers when things are not going well. Every single call and duration of that call has a $ associated with that. And every minute of outage, whether it's related to you or to an external factor, is costing you money. Now, different customer cares, different locations, different you know, priority of calls have different costs. But if you look at a financial or a payment company or a bank, and if there's an ISP outage in the region they operate, and that ISP outage is causing their clients not to be able to access their services, and therefore causing a lot of consumer calls to their customer care trying to figure out what's going on. Aside the brand impact of that specific financial institution, there is a direct cost that had nothing to do with their infrastructure. Another cost that, you know, when we talk to our clients, they try to measure and they try to put in KPIs to things like MTTRs, and they try to reduce those KPIs, because the more reduction in those KPIs, the less time spent troubleshooting issues that could or could not be their situations. With the same example there, if you look at an external factor, and if you're aware it's an external factor in real time, you're likely not to spend time internally with your operations team trying to figure out where the issue lies in your infrastructure, because you realize quickly it's not your fault. And that's a cost reduction. It's an indirect cost reduction, but nonetheless, time is money when it comes to downtime. On SLA side of things, you know, there are now, you know, what we're seeing from our perspective, we're seeing a lot of our clients doing their due diligence, to Jim's point and Andy's, but also relying on crowdsourced data to evaluate and benchmark those partnerships that they have, whether to see if these partnerships have been reliable over 1, 2, or 3 years and evaluate them to other partnership, or whether to look at the existing partnership and see if the reported outages or issues are compatible with what the consumers are saying in the market. Cost is definitely a key factor there. Again, going back to what I mentioned earlier, if you are a payment company and your transaction or transaction of a consumer is not completed via your payment method, they're going to default to somewhere else. There's so many other options out there today. And so that's also directly linked to revenue. And some of the clients that we work with today did a direct correlation between downtime, of internal downtime and external downtime, and revenue loss. And some of those folks, they use that on knock screens to display when a service is down or perceived to be down, how much is it costing them every minute. That's how sensitive downtime is for consumers and payment companies.
Great. So let's move on to some of the mistakes, the common mistakes that companies make, either on the business side or the technical side. And you guys have cited some of these already, but that lead to the failures. Jim, you already talked about the thinking AWS is not the answer to everything. What other common mistakes are companies making, or people making, essentially, that are resulting in failures and downtime?
Yeah, Heather, I think it goes back to that same concept, which is too often people are enamored with the kind of the public website and the sandbox and the marketing. No offense to a CMO, but the marketing materials that they find. I mean, again, like I said, it's like, oh, I can quickly cut and paste and get my payment infrastructure up and running. And I think we find a lot of companies that start that way eventually learn the hard way, so to speak, and come around looking for, okay, where am I going to move, either because I can't scale or I'm worried about actually growing my business on this platform. Because what was kind of a decision made around ease of getting up and running and documentation or the sexiness of a website doesn't translate into actually running a real business. And so scale, reliability, security, kind of those best practices start to rise to the top. But unfortunately, I think a lot of folks kind of get started with that kind of in a garage mentality. How can I quickly take payments or move money? And they tend to cut corners. And as everyone on the phone has said, that ends badly in financial services at some point. You're either going to have trouble finding a bank to partner with, or consumers and businesses will walk away because of the lack of reliability and security.
Andy, common mistakes that you see from your side that are leading to outages?
Well, yeah, I mean, I think a factor that's not necessarily the main cause always, but it's very often a contributory cause, is human error. And it's that in its turn is often management error. It's about, were there sufficient resources? Are your staff overtired? They may have made a configuration error, or almost like fat fingers type errors. These are quite common. People do some small error, then has cascading effects. So, probably the biggest single thing that any organization can do is have a culture of resiliency, where they adequately resource, they invest, they train, they check, they test, and when they've done all that, they do it all again. When they've done all that, they do it all again, because that is really what mostly reduces errors, or in almost every area. So I would say that it's when people start to view that as an insurance policy that's a bit too expensive and they want to cut back on it. The second thing I think is there is a rush to innovate sometimes, pressure to get things out, and they kind of think, well, that's important, but it's not necessarily as important as getting this product or service out this month. So that gets filled in later, but obviously later is sometimes too late.
I love that notion of a culture of resiliency. And it's not just a series of actions, but a way of thinking. Richard, from your standpoint, common mistakes that are causing these issues?
I think Andy's right. It's always or a lot of the time is a human error. Maybe it's a direct live human error configuration change that took place, or maybe a human error in planning where capacity storage or ability to scale was not planned proper, and may not be a live error, but 2-3 years down the road it takes place and everybody scrambles back to look on how did we get to that point. The other thing from my perspective is that a lot of the quote unquote legacy organizations do still depend on older systems and softwares. And in a lot of the cases, what we've seen is a lot of silos within an organization that kind of limits that interdepartment flow of information when situations like this take place. And that costs time, and that costs the consumers suffer from that indirectly because of the delay in resolving these issues. And the other component is to measure the impact of any situation from the consumer standpoint. Now, a lot of the organizations out there, they depend on simulation of how would the consumer behave with this app. They use probing data, they use bots to simulate the consumer behavior. But reality is consumers are humans and they all behave differently. And if you're able to capture that in real time, when there are issues and configuration changes, and in planning, when you're laying out plans for your infrastructure and how you want to drive your infrastructure, that would be a key element that I believe not every organization is taking into consideration. The real consumer behavior, not the simulated one.
Cool. Great. Andy, I wanted to sort of talk to you about, again, a good perspective in the UK, where you actually cited the example where the government noticed that people couldn't pay for their Guinness on a Friday evening in downtown London.
Half of the government probably directly affected.
And the last thing you want is someone in the government not able to chill with their brew. So, what do you think is the future, around that? If these outages continue, and we see the impact that Richard sees directly with consumers not being able to pay, and we do hear some really tragic stories in terms of where people have not been able to pay their rent, or left standing not able to pay for the groceries for their kids, and increasingly the underserved actually quite positively are being addressed by fintechs and being able to pay, but then they're super dependent on those fintechs. So given what you've seen in the UK, what do you think governments in the developed markets are going to do as they see these outages continuing?
Well, they're going to regulate, and they're going to regulate in quite a lot of ways. I mean, it's interesting you said if these outages continue, as though maybe it'll just go away. No, it won't go away. I mean, this is very clearly a trend. It doesn't have to be a very high rate. It's just that we are so dependent, and there is so many different systems out there that rely on payments. So I'll tell you about what's happening in Europe. I mean, the Bank of England have a white paper out. They're going to introduce regulations throughout the financial services industry. The managers of all the applications are going to be much more directly responsible. There will be fines. Not only that, but their IT suppliers must be inspected. They must provide, they must be open for tests, pass resiliency tests, etc. Rather like stress testing for finance, they're going to do that for the IT. The European Banking Authority, the UK doesn't work quite so closely with them as it did, but they are doing the same thing. There's an act that's being worked on at a European level called DORA, the Digital Operational Resiliency Act. I think I've got it right, which will set down rules for this affects both downtime and also information security, but it will set down rules, practices, standards, reporting regimes, and it will extend it out to the IT suppliers. And those that are not in compliance will face very heavy fines. And Europe has a history of imposing very heavy fines, and they will impose them. I think if there's a big downtime incident, they will impose them. And what I'm hearing, and I haven't read this myself, but a colleague told me that the plan is for the US federal government to introduce something along the lines of the European model. So I think that's the direction of travel.
Great. All right, guys, so we're coming up on the end of our session. This has been a superb discussion, really fascinating. Before I go to questions from the audience, can you each share kind of the 2 or 3 key takeaways that you'd want to have our audience take away from the session today? And Jim, why don't we start with you?
Yeah, I'll just reiterate what I said earlier, which is to say that reliability, resiliency, availability, info security are bedrock kind of pillars for financial services. Always have been, will continue to be. I mean, especially in electronic age where we now live and bank remotely, maybe never seeing a banker. The days of the brick and mortar institutions are moving increasingly rapidly away post COVID. So trust is key to that relationship, and again, those pillars deliver on that promise. So if you're not planning for it now, you better be, because either your customers will hold you accountable for it and walk, as we talked about, switching costs have disappeared, and increasingly regulators will hold you accountable. And as Andy said, you don't want to be on the other side of a fine coming from the EU. So one way or the other, you better be planning for it.
Okay. Richard, a couple key takeaways.
Sure, and I would add to what Jim and Andy said earlier is that it's so easy now to switch. So I would say the organization need to look at how their consumers are perceiving their services, and they need to take that into account. Purely from a consumer standpoint. The regulators are speaking earlier about regulators and how they define strategies and policy. They are looking at the consumer behavior today purely from a consumer standpoint, unbiased to the actual organization. And the financial institution, the banking, and any other organization that operates online or provide their services online will need to take that into account as a key component to how they plan and define strategy for the future.
Andy?
Again, I'll say what I said earlier, really, that I think organizations should have a culture of resiliency. If you don't, the cost is high, whether it's regulators or the customers will make you pay. So do all those things I said earlier, invest, and probably do it in a planful way. So conduct a business impact analysis of outages, work out what it is you need to do, because often the impacts are very high. So just take this very, very seriously.
Right. Thank you. Christy, any questions from our audience?
Yes, we've actually gotten quite a few. I know we only have 5 minutes, so I'm going to hurry through a couple. The first question is there a risk for being sued by consumers for downtime? What is the precedent here?
Andy, I think that's a good one for you. You kind of alluded to the
Right. So the first thing is I am aware of a lot of lawsuits that have taken place between different people, if you like, in the digital supply chain, that is, between platform providers, between banks and so on. And the first line in any of these is always, you cannot speak about this agreement, the dreaded NDA. So that certainly goes on, and that is kind of making life a bit difficult in terms of understanding how much is going on in terms of legal activity. In terms of the actual consumer, I think it will happen, and I know the courts don't tend to like that kind of massive boilerplate SLA text that people put in that no one ever reads. The courts tend to say, well, it's unreasonable to expect anyone to read it. So I think there's an opportunity. I'm not aware of a lot, but I definitely think Some lawyers will build up class actions, and or perhaps it's happened already and it's been NDA'd. I don't know, but it's definitely an issue I would imagine that will arise.
Great. Okay.
The next one is outage always measured in time, or are there situations where it's better to measure by number of transactions impacted?
Andy, I think that might be you again.
Yeah, that's a great question. I mean, I tried to make the point, that not all minutes are equal. So it's definitely too simplistic to measure it in time. So that's a great point. I mean, we list all the different ways that the impacts of an outage, whether it's transactions. I mean, not all transactions are equal either. So it's difficult, but clearly time alone is not sufficient.
It's a great question. I like that. Christy, anything
All
else?
right. Yep. Do we have time for one more?
One more, I think. Yeah.
Okay. So the question here is, at a high level, do you think there are competing incentives that can contribute to less resiliency that need to be watched out for? The example is incentives for being first to market versus vetting and testing partners and systems for reliability.
Jim, you want to?
I'll take a shot. Yeah. I mean, we see this firsthand every day, as I mentioned earlier. There's so much money coming into the broader fintech space. There's more money than good ideas, and as a result, when you're venture backed or private equity backed, usually those companies are really looking at the user experience or building out the minimum viable product. And I think minimum is the key word when it comes to resiliency and availability. I mean, that's not what they're looking to build. That's kind of like get it to the point where you've attracted enough consumers, you got some revenue growth to show for it, and then we're going to come back to that. So I do think there are real different pulls, kind of centers of gravity in this space. I mean, as we talked about, financial services, you need to be thinking about this on the front end, but oftentimes these new entrants put it on the back end to satisfy their investors.
Got it. Cool. Well, we are a minute from the top of the hour. Richard, Andy, Jim, thank you so much for providing your perspective today. I'm hoping our audience got as much out of it as I did. And have a wonderful rest of your day or evening. And thank you all of our audience for attending.
Thanks, Heather.
Thanks, everyone.